And we've got one such number, Coforge. That's the management that's joining in on the show. The company reported a very good set of numbers, a well-rounded performance. Margins declined, but also that was because of a couple of one-off costs. They also witnessed solid organic growth with good order intake. We have Sudhir Singh, the CEO of Coforge, joins us on the show. Well, Sudhir, it's not just your investors, but I think the markets are cheering you today because we have been missing any kind of earnings beats. So very good performance is what you have delivered. But can you keep up this momentum? Give us a couple of numbers. Organically, can we see a double-digit growth for this year? And also, what should the margin band look like? The last quarter was, a couple of D&A and other inorganic related costs were there. But on a steady-state basis, what is the margin band?
Well, if you look at our numbers, the Coforge organic business itself on a sequential basis has grown 6.3% in US dollar terms. And of course, when you look at our aggregate numbers, the firm has grown almost 27% sequentially over the last quarter. So as we look ahead and we look at the next 12-month signed order book, which at this point in time is 40% higher year on year at $1.3 billion US dollars. As we look at the order intake during the current quarter, which was more than $500 million, it was exactly $516 million. As we look at the fact that our large deal pipeline, beyond just the 3 that we've announced in the last quarter, is looking even more robust, we feel very confident that not just the coming quarter, which is quarter 3, but quarters to come should see very robust and sustained growth. And we will continue to deliver that growth as we have over the last 7 years.
Sudhir, hi, morning. So if you could put some sort of, rough numbers to that, so that we can understand on a full year basis, let's talk, FY25, what will the base business, the organic business grow at, given the strong commentary, and also what the total sort of growth is going to be, given the Cigniti acquisition as well?
We don't offer a formal annual revenue guidance, but as you can see, just the quarterly growth this quarter has been 27%. Next quarter, we expect it, even though it's a seasonally weaker quarter for the IT industry, to be a robust growth quarter again, as should quarter 4 be. So on the whole, this should be, I suspect, a standout year for the firm. The growth should be robust, and it will continue to sustain.
Okay, I think the only niggling issue, not nitpicking, but I think it was something that was pointed out that for the organic business, the margin dipped a little bit in the second quarter. Can you elaborate on what the reasons are? And I think you've indicated to analysts that there could be some additional ESOP costs in the quarters ahead as well. So if you could throw some light on this.
Absolutely. Our margins at the end of the first half of the current fiscal, our EBITDA is 125 bips higher than last year first half. Quarter 2, the drop that you saw was largely because of the fact that global annual salary increments were done in this quarter. The quarter in which you do it is the quarter that sees a downward blip. But overall, if you look at the first 6 months, we are 125 bips higher. And we believe that we have significant margin levers even going forward to make sure that we deliver or over-deliver on the margin guidance that we'd given for the year. We had said that our gross margin will go up by 50 bips this year over last year. Given where we stand right now, we believe we're going to meet that guidance and at a stretch exceed that guidance going forward.
But the EBIT level and the ESOP issue that I think was raised in the investor call, can you just tell us can you quantify the impact there?
Sure. The ESOP cost will be the same in BIPS level for the full year as it was last year. We've issued new ESOPs starting quarter 3. Quarter 1 and quarter 2 therefore saw a depressed ESOP cost, but when you look at the full year, the cost of ESOPs this year is likely to be at the same level as the cost of ESOPs last year.
So, Sudhir, morning, Prashant here. So gross margin expansion can be, 75 basis points, 100 basis points?
It's definitely going to be 50 bits that we committed to, Prashant, at the beginning. Currently, where we stand, at the end of the first half, it's 60 bits higher than first half last year. If that trajectory sustains, we might land up at 60 or maybe higher. But 50 at a minimum, which is our guidance, is something that we believe is ironclad right now.
You've already given us the headline, a standout year for Coforge. And it's almost as if I'm not talking to an IT company, because most IT companies are, when we speak with, still largely the commentary has been was slow and we're waiting for things to pick up, etc. But here you're talking about a standout year. So I mean, we're wrapping up 24. We're looking at calendar 25. Interest rate cuts have started. Does that add to the confidence for calendar 25 as well? I mean, any early indications of budgets, etc.?
Prashant, it does add on the margins to the confidence, but our story, the Coforge growth story, has never really been driven by the demand environment ups and downs. Even last year, which was a very tough year for the industry, we had grown 13% in CC terms at a time when most firms were struggling to get to 3, 4, or 5%. So obviously the demand environment easing with the interest rate movement that you alluded to will help, but even if it doesn't, we will deliver the numbers that we need to deliver.
Sudhir, throw some color on the Cigniti acquisition. Now that's closed out. How was that contributing? And you also mentioned there would be going to be cross-selling opportunities. So if you could quantify a couple of numbers on that front as well, and synergy benefits.
Absolutely. Cigniti in this quarter has grown sequentially 6.1%. So it's obviously exceptional growth that they've recorded. This was the first quarter in which we had operational control over that firm. Their margin, more interestingly, it's not just been a great revenue quarter for them. The EBITDA margin of Cigniti on a sequential basis has jumped 360 bips to 16.2%. When we announced the Cigniti acquisition, we had indicated that we would expect Cigniti to hit an EBITDA of 16.5% by the fourth quarter of this year. But we now believe that Cigniti is going to exceed 18% EBITDA by fourth quarter of this year. The cross-sell that you talked about is proceeding extremely well. The growth that we've seen in the current quarter of 6.1% sequential has not come because of the cross-sell opportunities that are in play. It's only been one quarter. We expect that impact to start coming in starting quarter 3 and to be fully reflected by quarter 4.
So that explains in part why you were saying this would be an exceptional year for Coforge. But just round it up for us. I mean, where is the confidence coming in from? I think the insurance vertical, as I can see the numbers here, has done really well for you. 8% sequential growth. BFS is growing. But, really, what makes you confident, and what are the sort of demand triggers that you're seeing out there and the clients that you're working with? I think you're executing contracts on the Gen AI side as well. So just some qualitative perspective as well.
Well, qualitatively, the thing that gives me the most confidence is the fact that every industry vertical of Coforge, every geographical unit of Coforge, and every technology unit of Coforge is doing well. To the point that you made, insurance has grown almost 9% sequentially. These are not YOY numbers. These are not annual numbers. These are sequential numbers. Insurance has grown almost 9%. Banking has grown more than 5%. The exact number is 5.2% sequentially. Travel has grown 6.2%. Emerging verticals have grown more than 7%. Now, when you have a firm which has all businesses, whether it's an industry cut, whether it's a geographical cut, whether it's a horizontal technology cut, all of them firing at the same time, you're not reliant on one vector which can go up or down because of an environment change. So a lot of the confidence comes, A, from the broad-based nature of the growth. Second, a lot of the confidence comes from the fact that our next 12-month signed order book is 40, not 14, 40% higher YOY. That number for a firm our size is $1.3 billion. And third, a lot of the confidence also comes from the revenue momentum. The last 7 quarters have been hellish for the IT industry. But if you look at us, 7 quarters back, we became a $1 billion revenue firm. 7 quarters later, of everything that's happened, at the end of this quarter, we're now running as a $1.5 billion firm. So a lot of that confidence, point number 3, comes from the execution that Team Coforge has turned in and is likely to turn out in the future.
Sure. All right.
Listening to you, Sudhir, a lot of investors would be calling up their brokers now. It's astounding and incredible as well. So it's an achievement, and beautifully summarized as well. So thank you very much for joining us. Great to have you with us here, and appreciate your time on CNBC-TV18. So, that's as Sudhir described, a tough 7 months, but Coforge has sort of navigated it quite nice. I mean, very, very nicely, and $1.5 billion firm now. So 7289 is where Coforge is. It's the biggest sort of earnings reaction which has come through. Well, we'll take a quick commercial break.